Is this video on?
Yes.
Yeah.
Should be on this side.
Can I just unplug one of these?
Yes.
Yeah, you can unplug it.
You want me to eject it or just pull it out?
It should.
I don't know if it really makes a difference. Can everyone see the screen on Zoom?
No, yeah.
Alright.
Should just click it and share it. Yeah.
I think if I play the presentation, is it going to show you when I switch slides, or
They'll be able to see it.
you see the title slide now?
Yeah, we're seeing.
All right, you see the abstract?
No, I got it.
All right. So maybe it's this screen. Now do you see the abstract?
Yes.
Okay. All right. So this is the kind of an interesting project that we've been working on for 3 years, and it's pretty much coming to an end now. But this paper here tests whether technical trading tools such as the moving average, Bollinger Band, relative strength index, and on-balance volume can be used to be used as a market timing tool for volatility sorted decile portfolios using the Center for Research and Security Prices CRISP database. And so prior research from 2014 has shown that portfolios sorted by both size and volatility can be timed using a moving average. Our hypothesis is to test whether this is the only technical trading tool that can be used, or if other indicators can also be used to time the portfolios. And so in doing this, we use annualized return, annualized volatility, Sharpe ratio, and an accuracy factor. And from the results, we see that all the indicators have accuracy in the mid to high 50 percentile, which is not consistent with weak form efficiency. And we show that the moving average 10 is the right tool for use in timing these portfolios, and that although the other indicators have positive return, it's not in excess of the buy and hold. So for a long time, the academic skepticism around technical analysis has been pretty much prevalent. It's phased in and out as far as a study in empirical finance, where it was in vogue in the 80s, kind of out of vogue, and then in vogue in the 2000s, out of vogue, and back lately. Early studies fueled the skepticism. Papers by Lowe, Mamaysky, and Wang 2000 in the Journal of Finance showed that automating technical analysis is more difficult than typical portfolio optimization using the capital asset pricing model, and that it might be a more difficult task to replicate the way that market technicians see and process information on a stock chart, which is part of the reason that they give 22 years ago that it doesn't end up that much in papers. However, despite all of the disbelief, it's used widely in Wall Street research, and I can, I guess, kind of personally confirm it because I've been meeting with a lot of people that are traders in Chicago and New York, and have found, a variety of their investment styles from value to momentum all use a lot of them use technical analysis in managing their own portfolios. So a large number of market participants believe that investors change their minds frequently, causing shifts in supply and demand, which trigger prices to move, and then technical traders would be looking for short-term inefficiencies to capture price trends and detect these shifts. Recent empirical evidence briefly has shown technical indicators do beat the buy and hold strategies. Brock et al. 92 use moving averages and trading range breakouts. Low, Mamaski, and Wang automate head and shoulders and non-linear patterns like the double top or broadening top. There's also recent papers that show volatility deciles, which is Han et al. 2013, as well as theoretical justification for the moving average, which is a JFE paper from 2016 by part of that same group. So for past studies, they've concentrated mostly on the popular moving average indicator. For each portfolio, what we do is compute a 10-day moving average, which is just the simple mean of prices for each portfolio. And the way the portfolio is constructed, kind of jumping ahead, is taking the last year's annual volatility and then making a bucket for every decile for every listed stock for share code 10 and 11, and then timing the in and out signal of an equally weighted portfolio among that group of stocks. So as we kind of get towards the end, I'll show the results in a bit, but fund managers that would want to use this type of strategy would basically look for a basket of stocks, maybe a smaller index like the Dow 30 or the S&P 500 or the Russell 3000, and then concentrate on maybe one decile. Obviously, higher volatility would be, what we'll show is that higher volatility is associated with higher returns. Lower volatility is associated with lower returns, but at every decile from low to middle to high and in between, the market timing strategy following the moving average beats out what the buy and hold would be, which would be considered the passive strategy. Once we get into the other indicators like the Bollinger Band, the relative strength index, and the on-balance volume, what we see is that they do show positive return, but not in excess of the buy and hold and not in excess of the moving average. And so then that would just lead us to conclude that the moving average is the right tool to use. So given some of that, one of the things that we do is hold the 30-day treasury bill as soon as the price falls below the moving average, and then we take the active return when price is above the moving average. We'll show some of the algorithms that we use for these indicators in the next couple of slides. Basically, we just extend the previous work by adding these new indicators and try and decide whether or not they can also be used, or if the moving average is the only one to follow. And they're all pretty similar in terms of price being a component in their construction. However, their use and the engineers that created them had different ideas, but the whole point is, for something like a relative strength index to show low value when it reaches an oversold level, high value when it reaches an overbought level, and what we do is buy when it's low value and sell when it's high value. And in relating it to the moving average, it's just a momentum smoothing tool, so it's just trying to smooth out the price momentum. Bollinger Band puts an upper and lower standard deviation around the moving average, and on-balance volume is just another way of including volume into the mix, which has been shown in literature by Bloom, Easley, and O'Hara to be a predictive factor, and also shown in Low, Mamaski, and Wang 2000. So we take the 10 volatility decile portfolios from CRISP. We start in 1963. We go through the end of December 2019. We chose that period to match up with FAMA and French factors. We find that the results are not stuck in just that period, so it's not like a black box. We want it to be as realistic as possible. So we test an earlier period out of sample from 1925 to 1963 and show that the results still hold from that period, and they also hold post-publication from the Hane paper, which ended in 2013. So we're constructing the portfolios from the NYSE, AMEX, and NASDAQ stocks that are assigned to each decile based on the last year's annual volatility, which is just using the daily returns from the previous year. Once they're assigned to the portfolio, then we just make an equally weighted index for each portfolio, rebalance every year based on the standard deviation of the last year. And we already talked about how to implement this for practitioners, so we don't need to go over that again. But if you're not familiar with these timing tools, or if you are, basically you're buying once the prices are above their moving average and selling when they're below. So for the results, I think you should be able to see it. It might be a little small, but what we're kind of focusing on is the first, there's 3 panels. So the first panel is those first 3 columns to the right of the rank. The rank is just each decile. Low is the low volatility decile, high is the high volatility decile, and then there's high minus low, which is created from the 2 deciles. We have the average return, which is annualized average return as a percent, and then we have the volatility in the column to the right of that, and that's just for the buy and hold, and then the T-stats are in the parentheses, and then we have a Sharpe ratio. That's panel A. For the moving average and each of the other indicators, what we're going to see is that the panel B, which will report for all the other indicators, panel B and panel C are going to be the active return from following that strategy, where we have the average return, volatility, and Sharpe ratio. And then the panel C is the excess return, so that's the active return in excess of the buy and hold. So just focusing on this one table, for the low decile, we can see that the average return is about 10%, and the active strategy is 14%. Both are statistically significant, but another key feature of that is that the standard deviation is about half of the buy and hold, while still earning a 4% better return. And so then that's what we pick up in the excess return, which is what we would use later for doing FAMA and French factors, trying to explain away that excess return. What's up? Okay. So the success ratio is the accuracy of in to out signals. So basically, if you're in the market on an up day, it's considered accurate for that day. If you're out of the market and in T-bills on a down day, it's considered accurate for that day. We can see that the success basically goes from high 54% to almost 58%. So we'll just kind of look at the other indicators briefly. Basically, what we see is, now we're just looking at panel B and C. So relative strength index has a positive return, but it's although it's statistically significant and low volatility, it doesn't beat the buy and hold. That doesn't mean that it's not useful. Practitioners often combine several indicators at a time on a chart, which going back to the low paper is difficult to automate the way that somebody would decipher signal from noise in a learning environment, a computer learning environment. And that's sort of where the field of computer science and finance are starting to merge, is that machine learning programmers are looking at how to make fuzzy decisions with using a combination of macro fundamental factors and technical factors. So we'll just look at the last couple and we'll conclude. Bollinger Band shows similar results, that the returns are positive and significant, but not in excess of the buy and hold. The MACD indicator also shows a similar result. They never show negative returns. Unbalanced volume performs a little better, but none of them really beat the buy and hold, let alone the moving average. So that tool has been shown previously to time the portfolios. We test whether it can continue to work post-publication and whether these other indicators, which are also formed on price, can time the portfolios. Although they have a positive return, they're not in excess of the buy and hold or in excess of the moving average, which suggests that the moving average can be the kind of primary tool for volatility in size portfolios, and size just performs similar to volatility, where small size would act like high volatility and large size would act like low volatility, which we also tested, but trying to save time and space with the presentation in the paper. So we did also do Fama and French factors, which we left out for space, which show that the returns still hold in the face of the factors for the moving average, but there's no excess returns on these other indicators to explain away. So that's what we have for that, and then we'll just open it for questions.
Any questions?
So do you use this to guide your personal investing?
I do a lot of stuff with the personal investing, and if you look at my Scholar, I have a lot of papers that are similar to this and a little different. And the short answer is, yeah, I do. The medium answer is to set it up in a live environment that would replicate the paper, is kind of like the area that I'm heading into, and I haven't taken the time to set that up yet. But if you search around Google, you'll see a lot of Python programmers that are setting up automated data feeds to basically set up a simple timing tool and automate that process, which would be to me the next step. Otherwise, you're constantly downloading data. But yeah, I would like to set it up. Most of the stuff that I work on, I try and set up to make it as realistic as possible and continue to track it out of sample, after I work on the paper. And that's kind of the goal with the paper, is you're looking for something that could have practical use and industry use, but then something that can tie into teaching and tie into research. And then you put enough time into it, you get a bunch of stats down, and you go, okay, this is probably enough for a paper. Let's see if there's literature there, and put something together. So yeah, looking at like the oversold area of RSI, like RSI, below its midpoint or below 40 or 30 is a pretty good tool. We test that more standalone with the Bollinger Band and get more into like robustness checks in another version of the paper. So yeah, I think it's worth looking at, but also in combination with everything else. I wouldn't just try and use something as a black box that you don't understand. But if you get into it, I think you'll see where the buy signals are, and you might like it.
Okay.
No problem.
Maybe ask on Zoom if they have any questions.
Anybody on Zoom have any questions? Or if not, thank you very much for the opportunity to present. Oh, I gotta get out of the file first. Cool. Thank you.
Awesome. Thank you.
No problem.